Today we're answering a question which I get asked very often. Do demo accounts accurately simulate live trading? And this is a very good question to ask because it really depends on what type of strategy you're trading. This video is sponsored by our free Golden Time Bomb Expert Advisor. Take your trading to the next level through automating the London breakout and the opening range breakout. Click the link in the description to download the EA completely for free. But I have come across in my time as an EA developer and company owner in the space, many users who are vehemently against the use of demo because from past experiences, they have been told that demo, once you put something from demo and you put it on live, the performance is totally different. And it really depends. So in this short video, I'm going to go over why that occasionally happens and when demo is pretty much indistinguishable from live trading, whereas in what scenarios is demo actually very, very different. And maybe to kick us off here, I can look at this nice page by Forex.com, which is one of the world's largest brokers in the Forex market. And here they say that the primary difference between a demo account and a live trading account is that there is no capital at risk when trading in a demo account. Obviously, so that kind of ties into the emotional aspect. But specifically, when we go to more of a CFD, MT5, expert advisor trading context, like what is the difference? And really it comes down to execution. And many people will tell you that like execution on a demo is going to be completely different than execution live because your slippage, your commissions, your spreads are all going to be rather different. And that you won't necessarily be able to model live execution in a demo account and contrast that to a live account. And honestly, what I would tell you here is, yes, it will be different, but the impact of that on your trading strategy will obviously depend massively based on how sensitive is your trading strategy to market impact and market conditions more broadly. So to show you what that would look like, let me pull up this quick chart here of one of our trading strategies, the Longbow Fund Manager, just to kind of give you an idea of what I'm talking about. So let's look at this particular trade here right in front of me. With Longbow, okay. These would be some losers. Let me pick a winner just to show you an example. This is good. So winner, loser, winner, loser. So what you guys can see is that this trade entered here at around 1:30 platform time and held all the way until the market closed. This was a very long trade. It would have been on an hourly basis, probably a little bit over 20 hours. If you hold a trade for 20 hours, do you think that a slightly different execution will make a tremendous difference? And keep in mind that this was the profit target here was huge, right? So obviously you could have the occasional trade which is wicked out by half a pip, and that would make a difference. But over a sample size of a few thousand trades, is it actually going to make a big difference if you're holding something for 16 hours? No, not really. So that's why, like, yes, spreads do make an impact. You are paying the spread, but fundamentally, spread is relative to how big your take profit is, right? If you have a tiny take profit, your spread might be the same size or half the size of your take profit. Therefore, it wipes out all of your profits. But if you have a take profit which is 1% and a spread which is 0.01%, 99% of the move is going to be attributed to your actual move and not to the spread. So the larger your take profits are, and then inversely, the smaller your lot size is, the less you're impacted by spread. So all of that to say, here, because it doesn't really matter if you have the absolute perfect fill if you're holding a trade for 16 hours, your conditions on demo and live are going to be essentially exactly the same. And same thing with futures, like even if you get filled at a marginally worse price, a couple ticks off, it's not going to make a huge difference. However, let's say you're trading an absolute scalper where you are holding for like half a millisecond, or especially like the more high frequency style bots, you're just in, out, in, out, in, out, in, out, then your slippage and your spreads and your fills makes an absolutely tremendous difference. And that's like the total like night and day. So really the answer to this question is if you're trading something which is heavily spread and slippage sensitive, then it will make a massive difference because that could vary enormously on demo versus live depending on the conditions in which the broker is giving you. So that's really the main takeaway from this. And to give you an example of what that would look like, let me show you a back test of another bot, one of our very good opening range breakout bots, but contrasted with spreads versus no spreads. So this is on the US 30. Let me just find it here. It's US Orb Fund. Give me 2 seconds. Here we go. And let's run this now on 2 different data points. This one is first 1 minute open, high, low, close. And as you guys can see, like, it's exceptional. Like, obviously this is a very good bot nonetheless, but we're seeing a, like, in terms of the statistics, a 5% drawdown with a 49% rate of return. And this is not a true scalper, but it definitely holds for a shorter period of time. And now let's contrast this to every tick based on real tick. So 49% return, 5% drawdown. That's what we should keep in mind. So here, now we're seeing a 7% drawdown and a 33% rate of return, which is still like an excellent bot. But like clearly that makes a pretty big difference, right? You went from 49% to 33%, and we went from 5 to 7. So this goes to show that clearly something happened. And what was that? And that was simply the more accurate impact of spreads. And that's essentially why people sometimes are skeptical of demo accounts, because when you run something which is more of a spread sensitive one, it will make a difference. However, now let me show you, for instance, our American Longbow bot, which is going to be running on the NASDAQ, and this, generally speaking, holds the entire day. Every tick based on real ticks. Let's run this one, and this is comparable to the one I just previously showed you. Oh, I think I'm running on the wrong asset here. Let me quickly, there we go. Back to defaults, and here we go. So here we're seeing roughly a 6% rate of return with every tick based on real ticks. So this one did not have an amazing start to the year. And now if we get the exact same thing, I think this might be, yes, we get the exact same thing with 1 minute open, high, low, close. We can see it's around 7.2. So essentially the performance is almost exactly the same. So this goes to show that when you have something which is less spread sensitive, then it's going to make a very significant, much less of a difference whether or not you're using perfect spreads or not. And this is why, this is like really the crux of the issue. If you're using a scalper, you probably want to test it on live funds. However, if you're using something which is much more of a swing trading bot, it really doesn't make a difference. So guys, hope you found that interesting, and yeah, I'll see you in the next video.